Hey everyone, and welcome. I am absolutely pumped to dive into today's explainer with you. We're going to break down a concept that honestly completely flips traditional real estate advice totally on its head. If you're a first-time home buyer, you've probably had the same old tired advice drilled into you over and over. But today we're talking about a strategy that is generating a massive amount of buzz right now. It's literally a secret mortgage hack. It leverages something called forced appreciation to fundamentally change the math of buying your first house. So let's just jump right in.
Okay, I want you to think about this question. What if putting less money down on your first home actually saved you $100,000? I know, it sounds completely counterintuitive, right? Like, no way. Literally everything we're taught says the exact opposite, that a giant down payment is the only safe, responsible way to buy a house. But what if I told you that by holding onto your cash, you could actually unlock a massive financial advantage? Well, that is exactly the insider strategy we're unpacking today.
So let's start with Section 1, the traditional mortgage myth.
Now, this myth is the massive hurdle that absolutely terrifies most first-time buyers. You know the rule, everyone tells you that you must put down 20% to avoid PMI, which is private mortgage insurance. Let's make this concrete. Say you're looking at a $500,000 home. A 20% down payment is $100,000. That is a mountain of cash to save up. But the alternative, a 5% down payment, requires just $25,000 out of pocket. That 5% is the starting line for this entire hack.
And that brings us to the magic number, $75,000. By choosing the 5% route instead of the 20% route, you are keeping 75 grand of your hard-earned cash right in your pocket. Now, in the traditional mindset, you've quote-unquote failed because you didn't avoid PMI. But in the investor mindset, you just retained $75,000 of highly liquid capital. What we do with that $75,000 is what transforms this entire transaction from a standard purchase into a wealth-building engine.
Moving on to Section 2, the forced appreciation hack.
All right, so here is where we have to reframe that dreaded acronym PMI. Because you only put 5% down, yeah, the bank is going to charge you private mortgage insurance. In our example, that PMI comes out to an extra $150 a month. Most buyers run away from this fee screaming. But let's think about it logically for a second. You are essentially paying a $150 monthly fee to keep $75,000 of your own cash accessible. You're buying liquidity. You're temporarily paying $150 a month to hold the key to unlocking massive equity completely on your own terms. And here is exactly what you do with that liquidity. Forced appreciation. Instead of just moving in and waiting years, crossing your fingers that the market hopefully goes up, you take that $75,000 you saved and you deploy it into high ROI, return on investment, renovations. You are actively forcing the value of the property up through really strategic improvements. You are completely in the driver's seat of your home's equity.
Let's get into the mechanics in Section 3, step-by-step execution guide.
Okay, if you're a first-time buyer, here is your exact, simple, mechanical playbook. Step 1, you buy the $500,000 house, but you purposefully only put 5% down. Step 2, you take that $75,000 cash you held back and you execute those high ROI renovations. Maybe upgrade the kitchen, fix up the bathrooms, whatever really drives value in your specific market. Step 3, this is the magic moment. Because of your renovations, your home's value shoots up and you organically hit that required 20% equity mark. So you call your bank, have them reappraise the house, and legally remove that $150 PMI completely. Gone. And finally, step 4. Your required monthly payment just dropped by $150. But, and this is crucial, instead of spending that extra money, you keep making that same total payment, directing that $150 explicitly towards your loan principal every single month.
Which leads us to Section 4, the massive financial payoff.
Let's quickly review the setup before we look at the final score. We started with the $500,000 home. We opted for the alternative 5% down payment, so just $25,000 out of pocket. That brilliantly left us with $75,000 cash, specifically for those high ROI renovations. And yes, we strategically accepted the temporary PMI cost of $150 a month. This is the entire board setup for the win.
And here is that win. Because you forced the appreciation, stripped away the PMI, and redirected that $150 straight into your principal balance month after month, compound interest works heavily in your favor. Doing this can literally cut a full 5 years off your mortgage timeline. 5 years. And even better, it saves you a staggering $100,000 in interest over the life of the loan.
Think about that. You kept your cash, you got a newly renovated living space, and you legally kept $100,000 out of the bank's hands. It's a game changer.
Now, let's take a breath and look at Section 5, Important Risks and Realities.
I want to be super clear here. This is an investment strategy, not a guaranteed outcome. The math we just walked through is a brilliant blueprint, for sure. But real estate isn't a theoretical exercise done on a calculator. It exists in the real world. Treating your primary residence as a vehicle for forced appreciation requires a ton of discipline, and you have to understand that things don't always go exactly to plan. Whether this hack actually works for you depends heavily on a few very real variables. First, your renovation costs. I mean, if you blow way over budget on a kitchen remodel, that eats directly into your equity. Second, the appraisal results. The bank literally has to agree that your home is worth more after the work is done. Third, local housing market conditions play a massive role. You've got to be in an area where buyers actually value the specific upgrades you made. Fourth, check your specific loan terms and PMI rules. Some loans have really strict waiting periods before they even let you try to drop PMI. And finally, interest rates. You've got to account for all of this. Please always run your own numbers and consult a mortgage professional before committing to this.
So this explainer has shown you how flipping traditional advice, putting just 5% down, temporarily taking on a $150 PMI fee, and forcing appreciation with your retained cash can potentially shave 5 years and $100,000 off your mortgage. It is an incredibly powerful playbook for the savvy first-time buyer. So the only question left for you is, are you ready to run the numbers on your first home?